Good morning to everybody.
Morning.
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 Good morning.
Morning.
I will remind everybody that all of the NAS meetings are recorded. You'll see that at the top of your screen, recording and transcription. So we record them, A, for the people who can't attend, and B, to prove that we are compliant. So I will remind everybody that this is a product meeting. It is being recorded. So for anti-competition laws, I need to tell you that there should be no discussion of prices or warranties, no specific prices or warranties. We can say that people are trying to put up prices or prices are dropping, but what you are not allowed to say is the actual value, be that of your own or of a known competitor, or any factors which might affect prices, such as discounts or margins and payment terms and conditions of sale. So it's exactly the same as the trade credit meetings that we hold. Don't tell anybody what your trading terms are. Don't tell anybody what your credit limits are. There should be no discussion of profits, profit margin, production capacity, although that's actual specifics of tonnage and everything else, what inventories you hold, or sales figures or cost data. There should be no discussions that lead to the raising or lowering of future price levels. There should be no we're all hoping for future price increases, but there should be no discussions regarding allocations of territories, markets or customers, nor any marketing or sales plans. There should be no discussions regarding the elimination, restriction or limitation of the quantity or quality of any product to be sold. And there should be no discussions or conduct at social events incidental to meetings that would not be proper in meetings. So as we're doing this over Teams, we don't need the one about the socials. So good morning, everybody. Welcome to NAS product meeting. We have got some very good speakers today. I would like to hand you over to Kallanish, please. I believe he's first on the agenda. Is that correct, Claire?
Yeah, that's correct.
Yeah, okay. So I will hand you over to Kallanish, please.
Hi, everyone. I think I'm going to go first. There's a couple of us on the call.
Yes.
But
I didn't know who wanted to go first, Thomas. So
I think we only just decided ourselves, actually. So, but I'll go first. Just to introduce myself, I'm Tomas Gutierrez. I oversee the Asian editorial for Kallanish, and also the global data and consultancy side of Kallanish. Later on, we're going to have Carrie. Carrie's more the UK focused person. I'm not really UK focused, but I'm going to give you just a quick.
Thomas, hold on one moment. You keep going in and out. Your microphone's not quite working. I can't get every word that you're saying. So you might have to turn your camera on. You might have to turn your camera off. But
all right, let's see. Hopefully that makes it better. Is that better? You hearing me a bit more clearly?
It's still a bit.
I can hear it fine. I don't know if it's just you, Ian.
I think it might be you, Ian.
Yeah, it could be my internet. So I'm going to leave and I'll come back. All right.
Okay.
Okay. Well, hopefully the rest of you can hear me. So I'm going to give you just a 5 minutes on China and Asia impact on global markets, a bit of an outlook, and then all of the more European and UK stuff will come from Carrie. All right, I'm going to just share a couple of slides here. Give me a second. Okay. Can you guys see this?
Yep.
Yes. Yeah. Okay. Great. So China, we released our forecast for China about a month ago, and the 2 sessions are ongoing. So there's a couple of updates from that. But I'm just going to really quickly give you a view. These slides are also available to anybody who wants it. You can just reach out, email me. I can send you a PDF version. It includes our book for China, which may be handy for some people. So basic outline is, China still needs to be exporting steel. And that is setting global prices and putting a cap on global prices. It's not a short-term blip, it's a long-term process because China's restructuring domestically the entire economy, not just the steel industry and steel demand. And at the same time as China is exporting, the rest of Asia is also going through a bit of a capacity surge, particularly Southeast Asia, but also Middle East and areas nearer to here. So it's exporting into an oversupplied market as well as being the cause of oversupply. So price pressures are expected to continue. That's basically the takeaway. So we expect an easing in exports, but not by too much. So you can see here the trend. Obviously, 2020 was a very different year to many of the others. But there's a clear recovery in exports since then. Last year, peaking at 117 million tons. This year, we expect 110 million tons. So a bit less, but it's not exactly a small number. And the need to export that to balance its domestic market means they will be trying to export as competitively as possible and therefore putting pressure on prices. This slide has our forecast. We've got forecasts by end user sectors. I'm not going to go through it bit by bit because that's not really the focus of this meeting, but I thought I'd include that in here. As I said, I'll make the slides available to anybody who wants them. So if you want the numbers, you can just ask for the slides. If you want the reasoning behind the numbers, then check out our Steel Intelligence China product, which has monthly updates on all of these sectors as well. The next one is out tomorrow, I hope. So prices are being slower with the China export price. Essentially, all prices are following that, and they are expected to continue doing that. There's a couple of factors that lead into that price pressure. One is the need to export. There's a couple of other issues in the market as well, including VAT tax evasion on Chinese export volumes, particularly some of the kind of high volume trades for kind of low grade HRC. That has been a growing issue over the last couple of years, and that remains an issue. That probably gives it around an 8% price advantage for Chinese FOB offers compared to what they would be theoretically if they were paying full VAT on those exports. The net result, FOB China prices are down about 53% from 2021. So no wonder markets globally are under a bit of pressure. Separately, I just finished a project, but the China FOB price, here we've got HRC flowing out, and it follows HRC through to Turkey. But you could look at any price, even prices that you wouldn't expect to correlate. The cost of demolition scrap in Germany follows Chinese FOB prices more than it follows European steel prices. So, this correlation impacts unexpected parts of the market, and it's really very widespread, the link to Chinese export prices. There's a few updates because we've had the two sessions. For those of you who aren't China watchers, the two sessions is essentially the Legislative Assembly, where China sets policies for the year or approves policies for the year. And markets over these couple of weeks tend to trade around expectations for that and whether or not they're met. So just a quick rundown of what was announced yesterday with the government work report. GDP targets this year were pretty much in line with expectations, around 5%. They hit exactly 5% last year. Worth bearing in mind that GDP in China works a little bit differently than it does in Europe. GDP is a target, and if they fall short of the target, they put some money in somewhere. So in a sense, steel actually benefits from from a bit of a slowdown, because the more the government panics with a bit of spending, the greater the proportion of funding that goes into construction and infrastructure. But that was more or less in line with target. Fiscal deficit is going to increase from 3% to 4%. So that's quite a large increase in fiscal spending. But again, that was more or less in line with expectations. And then two elements of government spending that are key for steel. Local government bond issuance. Market expectations have been around 4.4 to 4.7 trillion, and they came in at 4.4. So kind of at the bottom end of expectations. And then a central government bond issuance, expectations were around 1.3 to 3 trillion, and it came at 1.8 trillion, kind of in the middle. But out of that 1.8 trillion, 500 billion is going directly into banks because they're short on capital. And from the local government bond issuance, a growing proportion of that is also going into land purchases, which is less directly steel intensive. So overall, it's been fairly underwhelming in terms of steel markets. So you will have seen, I suppose, in terms of Chinese steel prices and Chinese steel futures over the last couple of days, not a lot of positive movement there at all. So that's all been very depressing. So what would make me bullish? Three things: a significant move to cut steel production, a sustained offensive against VAT evasion on exports, or a stronger than expected stimulus. So the two sessions so far, it looks like stronger than expected stimulus isn't on the cards. There's been a lot of talk about a move to cut steel production this year. There were rumors around a 50 million ton cut in production this year, but CISA have dispelled that rumor. I spoke to a VP at CISA just this morning, and he says in terms of capacity controls, they don't know when the policy is going to be revealed. They do want a policy. CISA wants a capacity control policy, but they don't know when it's coming, which I read as, don't expect it anytime soon. You might get something later in the year, but I wouldn't expect anything in the first half at least. And again, a sustained offensive on VAT evasion on exports. So far, no sign of it. My read on that is if China becomes much more confident in its economy, it might shift focus onto collecting some of its lost revenue because government finances are not strong. But as long as China is not sufficiently confident in its economy, that's an unlikely move as well. I've gone over my time, I'm sure there. So any questions, I'm happy to talk or afterwards. But I'm going to hand over to Carrie. Thanks.
Let me just share my screen.
Thank you, Thomas.
Better.
Are we good? Can we see slides? Okay. Oh, can we see first slide?
Yeah, I can see that.
Yeah, cool. Okay. So I'm Carrie. I'm the UK and European steel editor. My presentation is quite price focused, so sorry for that. And I'll just take you through some UK and EU focused things. Obviously, Trump's tariffs have caused uncertainty across the whole market, and pretty much everyone I speak to, there's not a lot of understanding, a lot of uncertainty, and a lot of things being put on hold at the moment until there's further clarity. Last week there was proposed CBAM changes. Obviously the UK one doesn't come in until 2027, but EU CBAM starts next year, and there's some proposed changes for that on the cards. The EU is also looking at its own response to the tariffs, and a safeguarding quota review is underway. This has really kind of paused a lot of things in the market, especially if EU kind of flats. Some producers are no longer offering quotes, waiting for an imminent announcement on what will happen there. And I think there is general expectation that the quotas will be reduced. I think there's been complaints in recent months and years that the quotas haven't kept up with where the market is. Obviously, the market has been really weak. Past year, demand has been really poor. Production has gone offline, and yet the quotas haven't really reflected that. And meanwhile, there's anti-dumping cases going on against China by various other countries, mainly Asian countries, but also in Europe as well. And that's, again, causing uncertainty for people who don't want to ship material and risk tariffs. And it's definitely slowing trade down, especially at a time when trade is already slow because demand is slow. Mainly for the UK market, obviously, when Trump announced his tariffs, and the UK was included in that, the plan for steel has been brought forward to try and push that to completion faster. There's also a review of the tariff quotas expected, and the UK industrial strategy is also expected. And as we know, the Steel Council is continuing its work as well, and there's also higher defence spending, which should support the steel industry going forward. The EU also has its Steel and Metals Action Plan coming up, and as we know, in the background is British steel talks rumbling on, but that is expected to be concluded in the coming months, apparently. So I took a brief look at the quota. The ones at the bottom in green are the ones that have more than 50% usage, but other than those ones, there's not a whole amount going on, especially after the uplifts. It's mainly the uplift that's been slowly kind of chipped away at the moment. We are also covering the UK market now. Our official publication launch of our UK price is imminent, and maybe a few of you already spoken to me about our proposed specifications for our UK launch. This is going to be a weekly price, kind of bog standard, usual stuff. And if you want to talk to me about this, you can, because it's going to be weekly and ongoing. And there's been feedback so far welcoming this, and people are happy to have it. Sorry to talk about prices, but this is kind of our initial data points so far. A small uptick since the start of the year, but kind of lagging behind the EU market, which I'm about to go on to. Cheaper imports from Asia at the bottom of the market, but a fair few people saying some mills just aren't really interested in selling the material, because they'd rather kind of upgrade it and galvanize it or coat it, and get kind of a higher margin for it. As I said, taking a look at the EU market now, there has been a upward trend since the start of the year. As we know, some mills were quite aggressive towards the end of last year, announcing price increases, quite big price increases, and somewhat settling for lower amounts, which is a bit more realistic. Re-rollers now looking to pass this on, but there is challenges further downstream where downstream demand does remain quite weak, and therefore it is quite hard to pass on those increases. There has been production closed in Europe last year, but margins are still quite squeezed. Southern Europe import market not holding on to any recent gains. In Europe, imports just aren't gaining much traction, and especially because there's a lack of Indian imports at the moment. The Indian HRC quota is 99% available. There's, I think, a safeguarding investigation going on at the moment, and no one's really willing to put that material on the water to Europe from India, and take that risk. And whilst this looks positive, there's a small upward trend here. If we take a step back a second, obviously we can see that prices are kind of well below this time last year. As we all know, there was a sustained downward trend last year, and then those attempts to push up prices in Q4 going into Christmas, but it's slow and hard work. Just to compare here, the US obviously having a great time. Prices have really moved upwards since Trump announced his tariffs. But in 2018, this happened as well. Prices reached a 10-year high, and then those gains were shed and let go. So we'll have to see this time whether it will stay high or whether it will trend lower. But we do see scrap also moving higher. It's up around $30 already, and we know that tariffs come into place for Mexico and Canada, so we'll have to see how that impacts the market as well. And that was everything by me.
Thank you, Carrie. Obviously, the prices are from the Kallanish indexes,
Yes,
so
all
they
published by
are.
Kallanish.
Yeah, so they are from a conglomeration of that. So they're not actually specific to any customer, or they are. I'm assuming they're an average. So I believe that we are fine with that. So thank you for that. Does anybody have any questions for Thomas or for Carrie, please?
I was going to ask, do you have obviously from when Trump came in the first time round and the curve, obviously from when it first inflated and how it gradually came back off again, have you got the data for that to share? Is that possible?
Yeah, it's on the Kallanish website. I can send it to you, or I can just tell you how to do it. Like if you just go onto the HRC US price and then change the dates, it's really clear to see. Yeah, it shoots up and it's sort of like fades,
worth looking at.
and it can just let go from all the gains after a couple of years. But obviously, after those tariffs come in 2018, there were exemptions granted widely and quite a lot of legal challenges and all the usual kind of aggro. So it's not surprising that those gains were let go of as the tariffs kind of weakened over time. I don't know if this will happen this time, but
yeah, no, I appreciate it. Just something to watch.
Yeah, I'll send it over.
So, sorry, Carrie, can you just pull up slide 5 again, please? Because I want to get a consensus from the group here.
Yeah. What was 5? Me.
It was the one about the quotas.
Oh yeah. Okay.
That's the one. So that's the HRC one, the 566013.
Yeah.
Yeah. So the one thing that is puzzling everybody at the moment is this 566013 Q1 allowance and the uplift. Our understanding of it is that is creating, well, we're wondering whether that is actually correct.
Oh, okay.
Because it just seems to be that
made, I think end of Jan, or was it end of February, that there was some tweaking on the quotas.
It just seems to be that across there seems to be 3 quotas all with 566. So that would be $1.7 million for 4 quarters, which would give you 6 million. But when the TRA signed it off, it was only supposed to be 2 million. Does anybody have a view on this? Because to me, everybody's bringing in 1 million. Well, the last 2 quarters have been over 1 million tons imported. Are we happy with these numbers?
Yeah, you're right. It's around 1.5, 1.6 ish per quarter for these ones. The 566 comes up 3 times.
If you go onto the TRA's website, it says that the overall for HRC should be 3 million a year. Well, that's nearly 6 million a year. So I'm wondering whether somebody has
there has been really big uplift though between the initial quota and then the uplift. Like India uplift was 200,000 tons alone just this quarter. So if you did that for 4,
no, but the uplift is the balance from the previous quarter, isn't it?
Yeah.
It's what hasn't been imported from the previous quarter. So there's three different countries all you're allowed to import 566013, which would be $1.5 million a quarter, which is 6 million. But the actual gap produced by Tata's production in South Wales was only, well, anything between 2.7 and 3 million.
But
so we're wondering why
it's the uplift from the original, though, Ian. So although Tata's obviously dropped production, you already had import tariff, quota availability. So it's just the uplift. So the uplift is uplifted by 3, but it was originally 3 to start with. Isn't that not correct?
I don't. It's just when I look at the news articles, I was having this conversation with Julian Vernon from ISTA. He tells me that the TRA told him that category B for the downstream producers was only supposed to be 2 million tons a year, which this isn't. I have thrown it up to the TRA and asked them for clarification. It just seems to be an odd number as to what they're allowing to bring in.
Yeah, so it's not my area, unfortunately, with it being flat, so I can't make much of a comment on it.
Yeah. Hold on. If can I do this? Let me just see if I can do this. And Carrie, if you can stop sharing your screen, yeah. I'll share mine. Can everybody see that?
Yep.
Yeah. So this seems to be the quotas that were given 58110, 58111, and this uplift is the balance that was on at the 31st of December from the previous quarter. So you've got, this is the initial, this is what the balance was left over, but this is what has actually been imported. But according to the TRA and all of the press releases on it, the downstream processors were only supposed to be getting 1.9 million tons a year. I'm wondering if we're going to be in the same boat as we were with the retrospective duty. So I have thrown it back to him because it just doesn't seem right. That figure seems very, very high to fulfill the gap that was being produced at Tata Steel.
What's the concern though, Ian? Obviously, the only downside to extra import is obviously on the producer, which is Tata, and they're the ones that have asked for the ability to import more coil, obviously. So,
well, no, you've got Tata, you've got Tata, Marsagali, you've got Top Chip, you've got loads of people who can all pick up 1B. You have to go and prove that you are a downstream producer.
Yes.
But to all intents and purposes, that effectively, it seems to be an awful lot of steel that can come in with no duty on it, which when you consider what Donald Trump is doing with duty on everything, we've lost category 2, which was the cold rolled. And now what the TRA have said in their press release that should have been 2 million now seems to be 6 million.
What's the detrimental effect though?
I don't know. I genuinely don't know how that washes out for
the only person that would have any concern on that would be Tata, and I'm sure Tata will very much have their foot in the door on that issue if it was something they were being squeezed on. But they're able to import obviously drops the imported price as low as possible, which obviously helps manufacturers. So I don't know what the detrimental effect would be, and I can see your angle obviously if what's meant to be and what is if it's different, but I don't see the negative impact on it at this stage for anybody.
Well, no, I just every time I open a newspaper and hear about the steel industry, that we are frightened to death that the UK is going to become a dumping ground for steel. So if all of a sudden we're not administering the quotas correctly or the safeguards correctly, then this could lead to, like you say, a detriment in price, oversupply, and everything else.
The only issue, like I say, that my personal opinion on that, the only person that has a detrimental effect on that is the producer, which is Tata, which I'm sure they protect themselves as heavily as they can, and they've got a good voice within government. So the lower the price in the UK for me, for manufacturers, it's the best solution. But yeah, I understand where you're coming from.
There might be some amendments made when they do this review that they're doing on the developing countries, because there's obviously the other countries quota exists as well. So they are going to be looking at the quota anyway. So there may be an outcome for this at the same time they complete their review and make a decision on what they're going to do on the developing countries.
Right. Yeah, because this is the government website. Sorry, hold on one moment. Let me share that.
The only other people that are usually sort of vocal on this point is that if you've got manufacturers that are heavy European purchasers and they're then competing against people who are importing from further afield, then you will usually find that they want the protection on the other countries, etc. That's the only people that I always find will, where they've got partnerships with European mills, for example.
Yeah, it's just that clearly says that the whole of category 1 should just be 2.9 million tons. Well, we've already bought in 2.6 million tons of hot rolled coil under 1B. So it just seems an odd thing to have. But we all know what happened with everybody. Well, we know what's happened with over 300 companies within the steel industry who have been smashed with a £41 million bill for retrospective duty because guess what? The TRA and HMRC could not get the system working correctly. but it just seems a bit odd. So I just wondered whether anybody else had any views on it. And I agree with you. It's Tata. Well, Tata, when they were a producer, the reason why the 1B's come about is because it's downstream production. But you can actually turn that into anything, can't you? You can roll it into whatever you want. So actually, it does have a knock-on effect to a lot of other sectors within that quota. You can bring it in and make it into tube. You can make it into, coated. You can make it into whatever. So I'm just throwing it out there just to see whether anybody's got any comments on it. So thank you very much to Carrie and to Tyas. Hopefully everybody found that. Does anybody have any other questions for Carrie or Thomas?
I think the question I was going to ask Carrie was, obviously you're doing the coil price and you're looking at doing other product pricing as well, sort of on a monthly basis, weekly, monthly basis.
Yeah, it's definitely, once we've done HRC, I think we are planning to look into doing other products, rebar or some kind of sections as well, to like expand the UK coverage now that I'm covering the UK market. So it's definitely on the list of things to do if people want it.
Yeah, definitely beneficial.
Right, fantastic. Cheers, Tom. Right, can I hand over to Phil Knowles from British Steel, who'd like to talk about sections, please?
Can you hear me, everybody?
I can.
Okay, good. You caught me slightly unawares there. I thought I was last, but I'm quite happy to go now. It's not a problem.
Phil, sorry, to be fair, you're right. Sorry, I've gone in the wrong order. Sorry, can I hand over to David Evans, who used to work for Dillinger, who's going to talk about flattened plate, please? Sorry.
You could have carried on, Phil, if you'd have wanted to. Yeah, I'm Dave Evans. I was commercial manager for Tata Steel for a number of years. So I used to work with Phil. And then I was MD for Dillinger UK for 8 years, so just over 8 years, and I left Dillinger at the end of March last year, and I've been working as a consultant and as an agent during that time, and I continue to do so. So if I look at the plate market in the UK, it's actually contracted over the years, so it becomes smaller and smaller, from probably a peak of close on 800,000 tonnes to somewhere in the region of 400 to 450,000 tonnes now, and that's dependent upon supply chain dynamics. So is it a pull in terms of steel coming in and less being sold, or is it the other way around? The UK is quite heavily influenced by the construction market. So including bridge building and machinery, and the numbers that are published are about 70% of the market are in that area. There's no longer one dominant producer since British Steel, Tata Chorus, pulled out of the market at the end of 2015, start of 2016, and it becomes more and more dependent upon imports into the UK. There's no integrated producer in the UK. You've got the 2 mills, or 1 mill that's working, which is a re-rolling mill, that's Spartan. So the high value grades are coming from outside of the UK. So the UK is quite commoditized, and that has become more and more reliant in recent times on third country imports. So people are tending to buy ship by ship. And South Korea's had a big part to play in what we see in the UK and what we've seen in Europe for some time. Mills are now starting to talk about price increases, small price increases around Europe. But at this moment in time, it's a watch and see brief, I think. The high level of imports at the docks in general may mean that the sort of increases that people are looking for may take a little bit of time to move through the market. So if I move on and look a little bit at the European plate market, I think capacity is around about 10 million tonnes, but the market size is circa about 8.5 million tonnes in Europe, of which 80% is supplied by European mills, and 20% is coming from outside of the European Union. And if you look at how that's split down, 56% of sales roughly are going to end users direct, which is a big difference from what we see in the UK, because in the UK probably 60-ish% will go through a service centre, where about 56% in Europe is going direct into end users. 21% into steel service centres, and 23% with classes merchant sales. And again, the biggest imports we see in Europe are from South Korea, and we'll talk a bit about South Korea in a few minutes. So in the last probably 2 years, I've worked with a number of mills that are outside of the European Union who are looking to do things differently with new mills and different sort of mix of business. And that might sort of change the dynamics really about how we bring things in. If we talk about new mills, the targeted approach to increase sales into the European Union, and that's a little bit of a move away from commodity sales to high value sales, and hence the reason why certainly 2 big mills came to me and wanted to talk about a European strategy, and I've done some work around that with people. Again, it's one of them where if you look at what's happening with Trump and tariffs, it changes the dynamic a little bit. There's been a big push, particularly in plate, because it's been a BOC Boss produced product. If you look at the green transformation, there's some of the big integrated mills have moved away from the big investments required, ArcelorMittal being one of them. Other mills continue along the path of the green transformation with high costs of the transformation, attracting some government support around the patch. But when you look at what people's view is in terms of the increased cost of going green, there is a high cost to do that, and people talk probably 180 to 100 euros a tonne of an uplift required to cover that cost. But what we've got to look at going forward is when we compare green steel against grey steel, the green steel producers won't be paying carbon credits, but the grey steel producers who don't have the transformation costs will be paying carbon credits to get their steel. So the gap might not be as big as many people believe, but there'll be a lot of changes and a lot of dynamics that sort of start coming along probably from 2027 forward, I would say. Then we move on to, I want to move on a little bit and talk about safeguarded action. I mean, we spoke about it already this morning a little, but the geopolitical market conditions are changing. The Chinese and Russian action was taken to limit that within the European Union and the UK. We saw an increase in Korean imports in both the European Union and the UK. But the Koreans have started to take action against Chinese imports of flat products, and the talk at the end of February was 38% duty. So that would actually mean that they would be looking to use more of their domestic product in their own markets. So does that impact on what comes outside of Korea? Reduced numbers, higher prices, who knows? We just need to keep a watching brief on that sort of area. You've got the carbon adjusted mechanism for businesses, so CBAM, which will impact when it all comes through and how does that work and that sort of thing. There's US threats and tariffs against steel imports, has already been spoken about this morning, which might mean that diverted products go to different markets. And I think we need to make sure that the UK as a whole doesn't become a dumping ground because we're not aligned to Europe, we're not aligned to other areas. So again, you already mentioned that, Ian, earlier. Is there 6 million tonnes or is there 2.6 million tonnes allowed into the UK? Just so to conclude a little bit, the geopolitical market tensions mean that we've all got to be very vigilant. I'm not a NAS member, but what I would say is that trade bodies such as NAS watching what's happening in the market can only be a benefit for its members. And I would say that it's important that we all understand what's going on, so we don't make wrong decisions. Happy to take any questions anybody's got.
Does anybody have any questions for David? Dave? Anyone? I always think it's a sign of a good presentation, David, that
Yeah.
no questions. You obviously covered everybody's what everybody's thinking about.
Well, I had a bit of a brief just to give a bit of an overview of the market, so I didn't really have a sort of a detailed thing that people wanted. So I wanted to try and give it a very general and talk about the market, so the UK, Europe, a little bit outside Europe. And I think some of the big questions around green transformation, safeguarding, that will be on everybody's sort of watch list, really.
I think Bedri Satilis has got a question because he got his hand up.
Yeah, hello, thanks. Hello, guys. This is Bedri speaking from Comic Steel, Germany. We are a Hong Kong and Shanghai-based steel trading company. And then knowing British Steel's connections with China, but also considering the current really unpredictable political vibes where Trump is getting closer to Russia, and now they will start also maybe peace talks with Iran through Russia and all those. It seems like West is not the West, and then East is not the East. We say like, and then we will see its effect in the steel industries as well. So it seems like China is being squeezed by USA, not with Europe anymore, maybe in the future, but in hand with Russia and even maybe Iran. This can happen. In this case, where will European steel industry, UK steel industry will place itself? Wouldn't it be more open to cooperations with China, for example, semi-finished products, where I believe Liberty Steel may be already importing from China? I'm not very sure about this.
Is that a question for me or a general question, Ian?
Yeah, today we maybe.
I mean, clearly, I was quite heavily involved with working with Eurofer going back probably 10, 12 years ago, when the anti-dumping action was taken against China for plates. I think there was two sides to that. One side of that was down to boron and chromium being added to plates that took it outside the standard, but it wasn't shown within the spec when the certificate came into the European Union. And part of it was just the dumping action that was taken. So I was quite heavily involved in that. I would say that probably remains across most product or some product areas. But I think the world's so changing at the moment. I think there's an over capacity within the European Union. So I think from a mill's point of view, the concern would be to open the doors again. Could cause a problem for the European Union and therefore a problem for the UK. So I don't really see a big change in that area personally. But I think everything's up for grabs at the moment. I think I was reading something only yesterday where Donald Trump was actually talking about putting bigger tariffs on South Korea than China, because he thought the South Koreans, even though they were friendly, were more problematic than China. So I think everything's up for grabs at the moment.
Yep. Thank you. Thanks a lot.
I think everybody is just struggling with the fact that Donald Trump just says something and then thinks it through after he said it, which does throw markets into turmoil, really. And I don't think he's quite got it.
I met with a few American people last week. We were talking about the action that Donald Trump was announcing. And what he was doing. And I think the general feeling from the American market was, this is what he does. He throws bombs out everywhere, and then reality kicks in, and it's to get people around the table to talk. So he's acting almost like somebody that wants to get people to talk, whether that's good or bad. But domestically, that causes him a problem because he has to get it through Congress as well. So it's a lot of gamesmanship, I think, at the moment, and trying to see what he can get for the US market.
Right. Does anybody know what's happening with the re-rolling plant at DL with Liberty? Because I know there was conversations regarding a government contract that they'd signed up for a big project up north, but because it's been mothballed, they're now going to the government and saying, well, if you want us to fulfill it, you're going to have to find some money for us. Does anybody know what's happening with that?
I don't know.
Because that is a big chunk of plate production that is now missing from the UK, isn't it?
Mm-hmm.
That re-rolling mill, yeah. Right. Does anybody else have any questions? No. Okay, can I hand over to you, Philip, please?
Indeed you can, Ian. Morning, everybody. I do recognise one or two names from the list, but there's quite a number that I don't. So for those that don't know me, I'm Phil Knowles. I'm the Commercial Director for Construction Sections at British Steel. Previously, I was the Commercial Director for the rods business. So I've only quite recently transitioned across onto the Construction Sections side. So don't ask me too many difficult questions, please, because I might be left a little bit red-faced. But anyway, thanks for asking me to come along. I wasn't sure, like David said, I wasn't entirely sure what sort of presentation you'd be looking for. So I've tried to keep it relatively high level and generic, a little bit about global steel position, although clearly I've been beaten to that by our friends from Kallanish, and a little bit about the UK and EU sections scenario, and what we maybe see going forward a little bit, but quite high level. But happy to take questions either at the end or as I'm going through. If people want to raise their hand, I'll try and answer things as we go along. Okay, let me share my screen and hopefully slides will appear. Can you see that?
Yes, I can say that. Thank you.
Okay, so start with just a little bit on global steel production position. I'll go through these really quite quickly. A lot of numbers on the slide, but if I just pick out the highlights. So annual comparison 24 versus 23. Overall, global steel production was down by about 16 million tonnes year on year, which is about 0.5% decrease. So essentially quite stable. If you look at the top 10 producing countries, then some of them are up, some of them are down. China was down 17 million tonnes. That was the biggest drop in actual volume. However, in terms of percentage, Russia was the biggest reduction at -8%. If you look at those that gained, biggest volume increase was India, plus 9 million tonnes, which was circa 6%. But again, if you look at it in percentage terms, Turkey was up 9%, and Germany also by 6%. And if we look at the top 5 in the EU region, volumes were relatively stable across the board. Overall, EU 27 countries reported an increase in crude steel production of 2.3%. Sadly, the UK was at a pretty much all-time low, 3.9 million tonnes, down from 5.6 million tonnes in 2023. But clearly, the actions that Tata have taken and our upstream operational instability were contributing factors to that reduction. Okay, if we move then from production to apparent demand across the regions, overall global apparent demand is forecast to be 17 million tonnes down on 2023. Still a forecast because some of the numbers aren't quite through yet, and that was a circa 1% reduction. 2025 is actually forecast to be just over 1% better than 24. So essentially, forecasting that demand returns to 2023 levels. If you exclude China, then the rest of the world was up 1.2%, 24 versus 23, and is forecast to be 3.3% up in 25. Excuse me. India continues to show the strongest demand growth. All regions are forecasting growth in 25, with the exception of China, Russia, and the other CIS countries, and the Ukraine. But clearly, the ongoing conflict in the region is impacting upon those numbers. And then if you look at the UK and EU 27, they're forecasting growth of 5 million tonnes in 25, which is just above the world, excluding China, growth percentage at 3.5%. A little bit dry, couple of slides there. So moving on to something more focused on EU structural sections. And you've got a map there that shows essentially demand and capacity across the different countries in Europe, and you'll immediately see that capacity is significantly higher than demand at 14 million tonnes versus 7 to 8 million tonnes respectively. Clearly, these numbers do fluctuate both from a capacity and a demand perspective, but that relativity is pretty representative of the overall current position. If you look at the UK, that's pretty much in balance from a capacity and demand perspective. But if you look at some of the others, then there's clearly a huge imbalance. And I've just highlighted a couple there. Germany, market size 1.5 million tonnes, capacity of 3.5. Spain, capacity of 2.8, but only a small domestic demand of 0.4 million tonnes. And Luxembourg, 2.5 million tonnes of capacity, but only 100,000 tonnes a year of demand. So there's quite some players there with a lot of capacity that can't be satisfied by their home market. Across the mainland Europe, 93% of section sales are in Euronorm standard sizes, whereas the UK is almost entirely BS4. There are third country imports into the EU, but they are quite restricted by relatively low safeguarding quota of less than 70,000 tonnes per quarter, and that's for all countries, including the UK sales into the EU, whereas the UK quota for European origin steel is significantly higher than that. So as a result, supply outside of the EU does become an important facet for many producers based in Europe. From a British Steel perspective, we can and we do export, but our prime focus is always on our home market, where we feel we can best leverage our proximity to the customers, as well as leveraging our lead time advantage and superior BS4 rolling program frequency. Okay, I'll move on. So the next couple of slides focus more on the UK, just on the last couple of years, on the UK market size and the British Steel share. It hasn't been a good couple of years for us in terms of our ability to service the market. I think it's been well documented that we've had 18 months of blast furnace issues with one or other of them, and that's been quite a painful period for us. Happy we can see now that we've got 3 months of stable operational performance behind us, and we're pretty much operating at full capacity now and looking to regain our positions in the market. But if we look at 2023, you can see there that we had a share just below 50%, and that's quite low to our historical levels, where we look to try and achieve a 60-65%. And British Steel sales into the UK on that year were 450,000 tonnes, and as we had issues at that moment in time. But even then, the UK supply accounted for 70% of British Steel's total sales. So again, clearly focusing on the UK market, particularly when we were having our operational issues. Market size just under 1 million tonnes, as I think I mentioned. If we look to 24, then the UK section's market size dropped quite significantly, as it did across most of the EU, to be honest. Went below 850,000 tonnes. British Steel share reduced further to 41%, and this, as I said, this was directly as a result of a very difficult year operationally in 2024, and our volumes were down as well. Share was particularly down in the final quarter, as you can see there. This is by which time our inability to service the market as we would like and as our customers would like had come to the point where a lot of our customers, sadly but understandably, had to take quite high import positions. So our share dropped significantly over the last 3 months. Overall, our UK sales still accounted for 72% of all our section sales. So we were trying to protect and service the UK market as best as we could, but we just didn't have the liquid steel capacity to be able to do so. But as mentioned, we are now back in a stable operating position. Just moving on. So in terms of the imports in 2024, just gives a map of where they originated. Despite our issues, we remained the biggest supplier into the UK, but only just, which is a sad thing to have to say, but it's the case. There are third country imports into the UK, but they are pretty much the exception. And you can see that the vast majority of imports come from the EU markets, and essentially from those whereby there's quite an imbalance between their capacity and their domestic demand. Spain, as you can see in particular, are a big supplier into the UK. In fairness, Spain, Germany, Luxembourg, they're always the largest importers into the UK. So it wasn't as though this was something new. It's just their share positions grew while we were absent from the market, which I guess is understandable. So just looking at EU consumption by sector, this slide gives a snapshot of the percentage of industrial production by sector, and construction is clearly a big indicator for construction sections. You see 23 was down on 22, and an even bigger fall in 24. So it was a difficult year across all of the region, driven by economic uncertainty and interest rate hikes and tighter monetary policy across the region. More encouraging, despite some ongoing uncertainty, 2025 is at least forecast to return to 23 levels. From a UK perspective, we did see a slow end to 2024 and a similar sort of start to the beginning of 25, characterised by ongoing project delays in release in January particularly. February, though, was much improved, and March is shaping up similarly, which is also encouraging for both EU and UK demand, both of which have been declining pretty much since Q3 of 2022. So we need to see that return of market activity to bolster the industry. Just a little bit on raw material trends. So British Steel is currently a boss route producer, and for those of you that don't know, we're pretty much the exception in the construction sections production field. The vast majority of all other suppliers are EF route already. So from a bus route perspective, as I'm sure everybody's aware, iron ore is by far the biggest constituent and influencing factor. Iron ore prices have risen quite steadily since sort of September, and have stabilized somewhere in that $100 to $110 a ton level, and pretty stable in that region. And if you look at pre-COVID historical trend levels, iron ore was more $70 to $80 a ton. So that it's stabilizing at historically is quite a high level. So that there's pressure on us from a cost perspective. Coal's behaved similarly over the same period and is similarly higher than the historical trend levels. So quite a difficult position for us to be in. From a scrap perspective, that had fallen off to a 12-month low at the end of Jan. I think it was $330 a ton, but we've seen that rebound and is now at I think $365 a ton. CFR Turkey, and we'll touch on that in a moment. So really just a recap of where we see things at this moment in time, and then I was going to briefly touch on a couple of other issues, but they have been talked through already. But I will touch on them nevertheless. So global steel production was slightly down in 24, but fairly stable, and is expected to recover to 23 levels during 25. UK and Europe is forecasting some overall growth in 25, as is the EU construction, EU and UK construction sectors activity. So we can expect a better year in 25. 24 was a tough year. Hopefully, we're seeing that was as the bottom end of the market. It was a tough year for the market. It was a tough year for British Steel. So we're certainly hoping for a better 25. I banged the drum about our operational performance now, so we're back to where we should be. Raw materials largely flat or creeping up, but it's historical high levels. So a little bit of a painful position for producers to be in relative to where the commercial issues find us from a, say, price perspective. And so these last two things that they've been touched on already, but I'll just make a couple of comments if I may. From a US tariff perspective, we're seeing a few things happen at this moment in time. So on the section side, we're seeing a significant increase in inquiry and activity level from the other NAFTA partners, namely Canada and Mexico, because clearly they're not exempt from the tariffs now and are reacting by turning their backs on the US producers and looking to source material from those that were already importers into their markets. So we're seeing a bit of a positive in that regard. From a sections perspective, quite a bit of what goes into the US or was already going into the US is generally outside of some of the size range of the US producers and tends to command quite a high price premium. So even with the tariff being applied, a lot of those who were supplying sections into the US can probably continue, if not exactly as they were, but certainly in some form. And as has been touched on earlier, I think it was by Carrie, we've seen that hot roll coil prices have leapt up, 25%, and we're seeing that now with the other strip derived products, and we're also seeing it now on heavy plate. What we've been told is the price lists aren't actually being increased, but the previous discounts are being discontinued, which is sort of masking the actions of the local producers somewhat. Nevertheless, it just means that the prices are pushing up. So if that continues, then we anticipate that sections prices can be competitive again relatively quickly. I don't know what that means necessarily, even with the tariffs being applied. And as currently all quotas have been rescinded, then we're not necessarily limited on what we could sell into the US if indeed we can be competitive from a price perspective. We are cognizant of the fact that, as touched on earlier, prices increased and then it was given away. So we need to keep an eye on that. So it's not necessarily all positive, but not necessarily all negative either. And the only other bit I was going to touch on there was obviously local scrap prices have gone up rapidly, and I believe that's for both domestic sale and export. So if you look at some of the countries like Turkey, who are a huge buyer of US scrap, then that could become an issue for them, and then the wider European market from a scrap balance perspective. CBAM, I won't labour the point. Yeah, it's going to come in from a financial perspective from 1st of January in Europe and a year later for the UK. Difficult at this stage to predict what impact that's going to have on trade flows and prices, but I doubt it'll be insignificant. Just need to have a watching brief and hope that over the period that we find some alignment between the UK and EU like we did on the ETS. So at least we can be in a balanced playing field between the UK and EU in that regard. So I think that's all really I intended to say from a presentation perspective. As I say, tried to make it quite general with a bit of focus on sections. But yeah, thanks for your attention. And if there's any questions, then I'll I'll do my best to try and cover them.
Phil, that was superb. Thank you very much. Thank you for the presentation. Does anybody have any questions? Anybody? No? Thank you again, Phil. Thanks for the presentation. Right, can we sort of go around and see how people are seeing the market? Tom, would you like to give us a bit of an update, please?
Yeah, still very flat as has been mentioned. Demand levels exceptionally low. There's no real signs of that improving, unfortunately. I think what was mentioned earlier by various people is pricing wise, we do feel it has been at the bottom for a while now. Some raw material factors, possible tariffs. Obviously, Trump coming in will have some short-term effects anyway that are maybe at this point, for me, a positive. You know, just some movements better than none. It's just been very stagnant for a long time. So we've got quite a few mill increases coming through on long products, you know, merchant bar, heavies. We're starting to see a bit of movement upwards. It's difficult downstream. The downstream market prices aren't really moving yet. We've seen little bits of movement, but generally speaking, it's pretty poor. Everyone's slice of the cake is smaller, so people are hungrier. They're going out looking there for more work, so it's very aggressive out there. And yeah, there's not much positivity to spread other than, yeah, hopefully we're at the bottom, and hopefully there's increases that'll come through and that'll push up. Like I say, short term, the Trump, whether you like him or hate him, at least he's going to create some movements. And I think, like I say, short term, everyone needs that. It would be nice to have some price inflation, even if it is only sort of a short term thing. People can at least have a bit of breathing space. I think 25 will be much the same all the way through unless we see some sort of geopolitical situation. You know, we see the likes of Ukraine war coming maybe a bit more peaceful, and we see some construction there, Palestine, etc. I think that's the only thing that's going to create any sort of real demand level from a European perspective anyway. But it's a global issue. So yeah, I think financial situations obviously don't help. Interest rates where they're at. Projects have been delayed. I think the one thing everyone was hoping for with a Labour government would be, okay, higher taxes, but also higher spending. And although we're obviously seeing the higher taxes, the spending hasn't come through yet. So yeah, I'd like to be positive and think that it will get better. But at the moment, it just feels very, very stagnant. And I think another thing that we mentioned earlier is the imports into the EU aren't really coming in as much as they were, and I'd put that down to the European prices being extremely low and super competitive. I think that will change. I think at some stage that will at some point create that spike and give people the ability to bring in products from further afield, maybe, and be a bit more competitive and create a bit more flow. Is that European price is so low that, yeah, you're not seeing the import options coming, whether it's Turkish, Indian, you know, further afield than that. But yeah, the European prices are definitely, as the comparison between a European price and your potential other options or your import options, the price levels aren't enough to warrant people buying further afield on longer lead times. And I think Carrie mentioned earlier, one other issue is because of the potential trade flows and the tariff situations is, do you buy from India when something could come in place? And why take that risk when there's no real gain to come from it either? But yeah, it's just tough, but it's been tough for a while.
I think the uncertainty that is currently in the market is just kicking the can down the road a few more months, isn't it? And with Trump coming in and everything else, and I don't think it's helped. Thank you for that, Tom. Jason Davis, please, from Corsair. Jason, are you there?
Yeah, I'm here.
How are you finding it?
Yeah, pretty much the same. Demand is probably the big issue at the minute. Slow demand, high stocks. Prices are milling around pretty much stable. Mill prices, you know, there's not a lot of fluctuation there. Everything looking forward is, I guess, on the up. But we're talking probably a bit too far down the line to see anything change at the minute. I'm hearing things into Q3, which pretty much says to me things will be stable probably for the rest of this year now, which isn't such a bad position really, if you think, as long as everybody can pick up bits, between each other without having to put any pressure on price coming back down, then everybody should pretty much be happy with what they're going to get this year, and then hope for better next year. So I guess that's probably where we are as a company, and we'll just try and ride out this year and wait for the better times to roll in maybe 6, 9, 12, 18 months time.
Right, thank you.
Right.
John from Eggleston, are you there?
Yeah, morning, Ian. Hi.
Morning, how are we?
Yeah, good, thank you. You?
Yeah, how are we finding it out there?
I think I say this quite a few times. We just don't bother trying to even entertain the idea of looking for bulk work. I think anything that's even as low as a ton, we're just fighting it out with the bigger guys to the point where, if you can make a tenner on it, you're doing well. So we've seen a huge shift. We're just going down the production route. I think anything that's got processing in it, whether that's plate or tube laser now, we've seen a good amount of work on that. We've had a good start this year, but certainly we've seen a drop in the tonnage. But we're picking up margin and turnover based on the production side of things. From a customer point of view, I don't think there's a great deal of sentiment out there that it's going to be a fantastic year, but I'd say that the majority of them are just saying, yeah, we're ticking along and hoping for good things. But yeah, I can't quite say how the year's going to finish. We've had a good start and we've got some decent jobs in the pipeline, but again, it's not based on bulk by any stretch.
Right. Okay. Well, no, I was speaking to somebody last week about CBAM, and they actually said that they thought it might be kicked down the road by another year because of the admin. So it's
that for us is still,
that again is,
it's still an unknown factor that's going to create probably a huge amount of additional cost that the margins aren't there to cover. So we're not quite sure how that's going to affect small independent stockholders like ourselves and to what degree. But yeah, we're just hoping some of the bigger boys out there start the process, and then we try and pick up the bones from it and figure out what we need to do.
Right. Okay. Well, no, I just think that by the time we bump down this year, it'll be another thing that will confuse or, just be noise around the market and demand and price, and it's not going to help unless it is clear, concise, and people know what they're doing. So, yeah. April from Top Tubes, are you there, please?
Good morning.
Morning.
I'm not necessarily going to talk about the market because I think everybody else is sort of like pretty much hit the nail on the head, to be honest. I guess the thing that we are now starting to see is that there's a lot of pressure with regards to credit, credit insurance, etc. And yes, we are starting to see some little bit of positivity around. There are, in some instances, some volumes to be had. The issue that we're all going to have if we're not careful, and this is just a heads up, and it's to anybody that is obviously on the call associated with credit insurance, is that we can't afford to be behind the times with it. When things do start to move, we are going to need to start thinking about credit insurance quite quickly. We're going to have a lot of companies that are going to have, poor results this year. They'll have had poor results last year, but do you know what? We almost have to help and feed that growth and that momentum by actually freeing up some sort of credit somewhere. I don't have the answer to this, and credit guys, you all have the answers, but it's just that heads up from a commercial business point of view that I can see that, as we start to head out towards the end of the year, we're going to have prices starting to increase, hopefully. That is all just starting to create a little bit of pressure at some point, and we can't afford to be behind the curve. Otherwise, we're almost creating a stranglehold like we did almost when we went into COVID. That was a really difficult time and we almost strangled it really quite nicely. We don't want to be in that position sort of all over again. So that's probably quite a selfish point of view, but I really just want to give everybody the heads up that it's not something for today, but it's certainly something that we need to be thinking about, because we're all trying to push, we're all trying to look for growth momentum, and what we don't want to do is try and create that and then it be strangled further down the line.
Is anybody else having those issues?
No, what I would say about credit issues is a good point. A lot of times we end up talking to customers, perhaps who are maybe struggling on credit, and a lot of the time the answer is they need to go and speak to the credit insurer themselves. A lot of the time, we've been able to help. I wouldn't say help, but if they're talking direct to credit insurers, they can help themselves a lot more than sometimes the trader can. But I do find a lot of the times, it's not speaking for everybody, but maybe their finance departments are not talking to credit insurers as much as they should, and working that out between themselves. I'd recommend going down that line for anybody who perhaps doesn't get involved down there.
As Jason says, communication is the key element to keeping those in place or stopping them from dropping or even increasing them. The difficulty is obviously people have had bad years, cash flow is tight, and one thing to obviously is keep on top of that, but at the same time obviously keep your wits about you as well. There'll be people that will change their supply options based on necessity. It's just being wary of that at the moment. I think the marketplace is going to be tough for a while. Yeah, it has been tough, and some people are going to start becoming undone, and that's the ones we need to be careful of. So just making sure you trade within your limits.
Absolutely. I see Tom Bryant's on here. Tom, can I have your perspective, please?
Yeah, feel a little bit pressured following those last conversations. Yeah, I think you are absolutely right, guys, with regard to credit. We have seen, for our point of view, I think, and I don't want to speak for everyone, but this is just kind of my view, but the demand or the lack of demand is kind of like that's been the big issue for us. We've been in a declining price market. We understand that. It seems to be bumping up slightly at the moment. Whether that'll stick or not, I don't know. But what we do have is certainly price stability. We haven't got the big yo-yos that are going up and down, which always leads credit insurers to be unsure as to what's actually going on at companies, because we're always looking back at the latest figures, which may be filed accounts, they may be managements, but we're always looking back. We can't quite see into the future. So talking to people, getting the latest managements and understanding companies and how they work is very important if we are going to start increasing credit limits in line with prices as they go up. I suspect we're still probably holding some limits with regard to historic pricing. So I think there's probably a lot of fat. Certainly what I'm running, I don't expect to actually have all of that exposure being used at the moment. But what we are looking at is the cash flow. We're quite aware of the cyclical nature of the steel market. Certainly looking at December 23 accounts, you could almost expect most people to have worse accounts in December 24. We need to kind of understand their cash position and headroom availability in a stagnant market, and whether we think they can fulfill forward orders as volumes increase and prices increases. Information is key for that. So I think it was Tommy said and Jason said, we're more than happy to talk to people. I think people are opening up a lot more. We are seeing more as being alongside banks. So PACs come out to us, but it is kind of heading off any kind of issues before they become issues. So I think it's Jason, if you can, certainly get people involved and get them talking to us. Some people like to talk to credit insurers more than they like to talk to their own clients because they don't necessarily want to see losses or profits coming through. Just to caveat all of that, we are seeing, while claims generally are okay, I think we had an okay January. February was higher, but still kind of on budget. It was noticeable that there are more insolvencies and overdues coming through from this sector. So it is, while it's not bad, it's nothing terrible. It seems to be more smaller companies, and possibly some. I don't want to go down the moralistic line, but there have been more insolvencies, and it's just something we're keeping track of. It's not large, but certainly they are building, and it seems to be smaller companies who have probably been hanging on as much as they can. But when the demand is that low and people are fighting, there are inevitably losers. So just something to be aware of. We are taking a bit more of a spotlight, but I don't think there's any real issue for us to take any actions as it stands. I don't know if that's helpful or not.
Thank you, Tom. Shannon, can I just have a couple of words from you, please?
Yes, certainly, Ian, pleasure. Good morning, everybody. Yes, similar to what Tom was saying, we're probably no major surprises when we're seeing a lot of the figures coming through for 2024. Yeah, it was a much more challenging market conditions, demand and prices. I think what's important for us is, as always, we don't want to be looking in the rear view mirror. We want to be, having a forward-looking view. And I think where companies can give us forecasts, give us, some projections, perhaps projects they're working on, who their key suppliers are, because often sometimes suppliers move around, and it helps us take out deadwood limits and put the cover in for people that need it. Keep talking to us. We're always happy to engage, and also, banking lines, or headroom availability. I think you mentioned last week, Ian, about we don't sit too much in this sector, but yes, certainly HMRC, that can be an issue at times if there's time to pay initiatives there, or they can fast track very quickly to statutory to a winding up petition without a statutory demand. And then if others jump on the back of that petition, you won't get it lifted. So that's always a red flag if we see that in management accounts. And I think as the golden rule for us, really, I would always say is no nasty surprises. Help us understand if the numbers don't look good, talk us through it. What's your plans to turn the business around if they are showing heavy losses? Just talk to us, help us understand. No nasty surprises, and we'd always look to work with you and support you wherever we can. Thank you.
Fantastic, thank you, Shannon. I'm mindful of the time. Is Mark Nicholas there from Alternative? Hello, Mark. Are you not there?
It does help if I turn my mic on, doesn't it?
Right, there you go.
I am here, yes. Not really a lot to add to that. The processing has been the key to us to the start of the year. Volumes have been on the floor, and yes, we are worried about the bad debts that are out there. A little bit suspicious about people who just turn up all of a sudden and want to trade with you who haven't wanted to before. But yeah, we've been here before. We'll get through it, and happier times coming up in maybe a year.
Yeah. Well, I know Tom said something about the fact that there are lots of people, because of the way the market is, people are fishing around. So it does actually lead people who are not credit worthy to be fishing around to get new accounts and everything else. So just be mindful of that. And I know there's been some fraud, being perpetrated out there, which Let's Talk Credit have notified us, and hopefully as members you've been getting that information through. So people who are impersonating other companies to get steel deliveries or pickups from lorries that are coming in. Okay. Is there anybody else who has got anything that is a burning question that they have for the group? Roy, sorry, Roy. Just seeing you down the bottom. How is the profiles business? Because again, it's processing, so it's a bit different. Are you on mute, Roy? Hold on, I think you're on mute. Right. I'm mindful that it is 11:30. We set aside an hour and a half. I hope everybody's found that informative. I'd like to thank everybody for the presentations and for participating. Thank you very much. To Thomas, to Carrie, to Dave, and to Phil. Obviously we have a face-to-face meeting in Leeds on the 3rd of April, which is a joint meeting with NIAS. I hope to see everybody up there, and enjoy the rest of your day. Thank you very much for your time.
Cheers, guys. Thank you very much.